You've done deals in the past, but nothing approaching the size of this, nothing approaching its scope in terms of geography with the international assets. And I know you'll make a different argument, but also on antitrust. And so I guess my question is, why is it worthwhile for Disney to undertake this risk, to give 25% of its stock to Fox shareholders for this deal?
Well, I think it has to start with the quality of the assets that we're buying. Rupert has managed over time to assemble just a stellar group of assets. And as you pointed out before I came on, they're global in nature.
Welcome to the channel, everyone. In today's episode, we're going to be analyzing Fox's global operations and discuss why Disney was so interested in acquiring them. We'll examine the role these international markets have played in growing Disney Plus subscribers. Then we'll wrap up the video by looking at the bidding war that erupted over the ownership of Sky. We've got a lot to talk about in today's video, so let's get right into the weeds of things and pick up from where the intro video left off. Now, at the time of this interview, Comcast had not expressed their interest in Fox's assets, and Iger was under the impression that Sky would be included as part of the transaction, which, of course, didn't end up happening. After a full-on bidding war erupted, Comcast ultimately came out on top, acquiring the company for nearly $40 billion. While the loss of Sky reduced the scope of Fox's international operations, they still had an ace up their sleeve, with India. Prior to 1991, the Indian television market had been monopolized by the government. Star India, formerly known as Star TV, was one of the first private broadcasters to launch in the country. The initial service was slim, with just 5 TV channels, but from this modest beginning, Star India grew into a giant, which as of 2019 distributed approximately 25% of all television consumed in the country. Their direct-to-consumer offering, Hotstar, has an even more dominant position, with nearly 40% market share of all long-form digital video consumed within the country. Hotstar was launched as a free, ad-supported service, and any programming shown on Star's linear TV networks was made available nearly simultaneously on the free Hotstar service. This may seem like a poor business decision, but due to the way the Indian media companies are regulated, the way they monetize content is highly skewed towards advertising rather than affiliate fees. Thus, providing their content for free on a direct-to-consumer basis made financial sense. The service proved wildly popular, and Fox had grown its user base to nearly 300 million monthly active users. Upon the deal closing, Disney wasted no time in positioning Hotstar as a customer acquisition vehicle for Disney Plus, and after just 9 months of operation, Disney Plus Hotstar had more than 25 million subscribers, representing nearly 30% of the total Disney Plus subscriber base. Thanks to Hotstar, management smashed their initial subscriber forecasts. They had previously guided that the service would have between 60 to 90 million subscribers by the end of fiscal year 2024. Yet by the end of 2020, Disney Plus had already reached an astounding 86 million subscribers, near the high end of their initial guidance and 4 years ahead of schedule. Management has since updated their subscriber guidance to a range between 215 to 245 million subscribers, with 30 to 40% of those coming from Disney Plus Hotstar. While there's no disputing the success of Hotstar from a subscriber acquisition perspective, it must be noted that these subscribers come with a materially lower ARPU, or average revenue per user, than what the company receives from its core Disney Plus markets. Here we can see that the ARPU in their core markets, which is defined as international Disney Plus operations excluding Hotstar, and their US and Canadian service, was $5.96 for 2022 and $6.24 last year. When we compare this to Disney Plus Hotstar, we can see it's dramatically lower at 58 cents and 64 cents. These figures roughly shake out to about 1/10 of what they receive from their customers in their core markets. When it comes to the sustainability of Disney Plus Hotstar subscribers, one thing we have to talk about is the Indian Premier League, or the IPL. In India, cricket is king, and in 2017, Star purchased the global broadcasting rights for the IPL for the 2018 through 2022 season. This included the digital rights for Hotstar. Last year, Star renewed the TV rights for the 2023 through 2027 season, but Viacom 18 won the digital rights. So while Star's linear networks will be able to continue to distribute the IPL, Hotstar will not. And this will put pressure on the service. The CFO of Disney, Christine McCarthy, guided that the loss of the IPL may result in lower Disney Plus Hotstar subscribers. So will this impact the company's ability to hit its subscriber goals of 215 to 245 million subs by fiscal year 24? I don't think so. Remember that of that total, 30 to 40% were expected to come from Disney Plus Hotstar. This represents a range between 64 and 98 million subscribers. At the end of fiscal year 22, the service had 61 million subscribers. And while losing the IPL will undoubtedly result in some subscriber churn, we shouldn't discount the general entertainment offerings still on the service. With over 100,000 hours of dramas, movies, and local language content, the service is hardly bare-boned. What we're likely to see is more price elasticity as the company adjusts their pricing to reflect the loss of the IPL. This will likely result in a lower ARPU going forward, but also a lower programming expense. All in all, I expect Disney Plus Hotstar to meet the subscriber expectations, albeit at a potentially lower ARPU. To wrap up today's video, I want to talk about Sky. Bob Iger notoriously referred to it as a crown jewel of Fox's assets and repeatedly praised the company. Fox, which already had a 39% ownership of Sky, initially offered to buy the remaining 61% of the company for $10.75 a share. Comcast then came in with a higher bid, which in turn prompted Disney to subsequently raise their offer. This back and forth continued between the companies until a blind auction took place to determine the fate of the company. Comcast ultimately came out on top with a winning bid of $17.28 per share, a 60% premium above the initial purchase price Fox had offered. So what is it that drove these companies to compete so fiercely over the ownership of Sky? For Comcast, acquiring Sky seemed like a natural extension of its existing operations. Like Comcast, Sky is a telecommunications and broadband internet service provider. Therefore, acquiring Sky was a logical move as it served as a means to expand into international markets and business segments that aligned with Comcast's core competencies. Add to this the personal feud between Roberts and Iger, which goes back to Comcast's hostile takeover attempt of Disney, and the conditions were right for Comcast to not only acquire Sky for itself, but also deprive Disney of these assets. From Disney's perspective, owning Sky's distribution network throughout the United Kingdom, Ireland, Germany, Italy, and Spain would give it yet another platform they could use to accelerate the adoption of their future direct-to-consumer offerings. Bob Iger had also grown a deep respect for the company through experience in trying to compete with it. From 2009 through 2013, Disney acquired broadcasting rights to the English Premier League and attempted to establish a foothold for the ESPN in the UK. Even with the marquee sports rights, the ESPN UK segment suffered meaningful losses and ultimately was sold to British Telecom in 2013. And before the days of Disney Plus, Disney had first experimented with a direct-to-consumer product in the UK called Disney Life. The service failed to gain traction as Sky's pay TV network and direct-to-consumer offering, Now TV, had already established itself in the marketplace. In hindsight, it may have been a blessing in disguise that they lost the bidding war for Sky. Fox ultimately ended up selling its 39% stake to Comcast, and the proceeds helped reduce the strain on Disney's balance sheet. While Sky is an impressive asset, the bidding war may have driven the price up to unreasonable levels. Comcast has since taken an $8.6 billion impairment on Sky, as accelerated cord-cutting trends and a destabilized ad market has put downward pressure on the earnings of the company. If you found today's video informative, please give it a like, and join me next week for another episode of Into the Weeds, where we'll be doing a deep dive analysis on Hulu. That's all for now. Take care.